There are two projects that I've been working on that I am super excited about, and so they're already in the works, and you'll be seeing them pretty soon. One will be replacing my blog, which I've been, whether it's been a blog or a conference call or in person, but over 12 years I've been presenting my information to the public, and I'm shifting in the way I'm doing it, so I'm excited about that happening. And like I say, it's already happening. It hasn't happened yet. So you'll see very soon what's going to be replacing my Saturday blog. So hey guys, this is RC Peck with Fearless Wealth, and on the screen here, if you don't look, just please don't, and just ask yourself, what type of company is this? Meaning, is this a company that has figured things out? This is a price chart I'm showing you. Is this a price chart of a company that has really figured out how to sell its product and how to just create raving fans? Or is this a company that just doesn't quite have itself kind of figured out of who its market is or what it's doing? Right here from, call this January 18 to January 19, 1 year, actually it was less than a year in 2018, this stock fell by a third. It then went up by 33%. But imagine a company falling by 33%. Now, what if I told you this company was the second largest economy on the planet? In fact, this was the Shanghai Stock Exchange. Now, some of you could look in the upper left and see that, but even if you did, you have to think like, wow, is this a company that really knows what it's doing? And it's not just a metaphor, right? Because today, every individual country is like a company, and people can buy individual countries like they can buy individual companies. So in fact, China is a company. And I look at this price chart and I see a company that does not know whether its stock price is going to be up or down tomorrow. Having the second largest economy on the planet get cut by a third in 11 months is pretty significant. And actually, it's less than 11 months because I was taking it right to here, but that's 10, that's 9 right here. It's the same low. So in about 9 months, the Chinese stock market was cut by a third. That's impressive. The other thing that I find really impressive with this price chart is the amount of gaps. Gaps are when the market opens way higher or way lower than what it opened the trading day before that. And it's just really amazing to me how we have these huge gaps consistently. And again, the second largest company on the planet, which is called China. So do you think the Chinese government, who is not elected, do you think they're going to let this price chart fall too much more? Or how much more? I'm willing to bet they're going to do things with their own equivalent of money printing or expanding their balance sheet to make sure that their own company does not fail. Because one thing that my friend Brian always told me, and in fact it was something his dad taught him, was that the system protects itself. Chinese government is going to protect itself, and the way they're going to do that is to make sure their stock market does not fall that badly. Especially, by the way, if the rest of the world is doing so much better. Which takes me to my second chart. This is a price chart of the MSCI EAFE, which is basically the international large caps. So these are the largest companies on the planet, minus US large companies. And it's also a 3.5-year price chart. And I put that little yellow bar in there to kind of point out to you, hey, if the price is above that bar, it's pretty hard to get negative about the world. Now, this is excluding the US. If we included it, this squiggly price chart would look much, much, much better. But this does not include the United States. And so what this does include is the previous chart. It includes the largest economy on the planet. Again, in this price chart is not including the US. So this price chart includes China, and still it's holding up quite well, and it's wanting to go higher. It's wanting to go higher. And I noticed something, and you might be like, oh my God, RC, seriously? Interest rates again? Like, you gotta you got to save us here. Like, I really don't want to talk about interest rates or hear anything about interest rates anymore, but I'm going to talk about them one more time. So, on the screen here is a 10-year price chart. The black line is the German 10-year rate or yield, and the red line is the Japanese 10-year yield. Now, what I find interesting is since 2016, the beginning of 2016, just a tinch after 2016, also known as 4 years or the last 4 years, the yield on the Japanese 10-year was always lower, right? The yield on the Japanese 10-year was always lower. But something odd has changed. And about 3 months ago, the yield on the Japanese 10-year is higher than the one for Germany. And I just think, does that mean Europe's in more pain than Japan is? Which I don't even know how much debt they have to GDP. Honestly, I actually don't think it matters because I've been hearing about the debt of Japan for 15 years. The first time I visited Japan was in 1990. You can do the math. That was 30 years ago. Did I do the math right? It was 30 years ago the first time I visited Japan. And I remember learning 30 years ago that Japan was in trouble. Japan was in trouble because their population was not growing. And yet, if any of you have ever been to Japan, it is easily the safest country I've ever been to. And I've been to about 50 plus countries on this planet. And it is by far the safest country I've ever been to. The quality of life is incredibly good. And so all of these fear mongers that say Japan's going to implode, they need to take a trip over there. But I find it interesting that the yield on the Japanese 10-year is actually above. Now, look, it's still, actually, I think it's right at zero. I was going to say it's still negative. It's right at zero. So now the Japanese 10-year is yielding zero, while the German 10-year is yielding negative 37 basis points, also known as yielding about a negative third of a percent. To me, that's pretty impressive, and it says more about the weakness in Europe than Japan. But guys, look, Japan's going to protect Japan, China's going to protect China, Europe's going to protect Europe, and the US is going to protect, let's just call it the US. So you've got these four huge economies, right? They're the four biggest economies on the planet. I know Europe isn't usually considered an economy, but they're going to protect themselves. And the way they protect themselves has been, since 2008, the last 12 years, lower interest rates and some form of money printing. Some form of it. Each country has its own form. And so I bring this up, and one of the reasons that I'm changing my blogs or getting rid of my blogs is because I kind of think I'm part of the problem by giving out my research, right? By giving out this data, because a lot of times I have the experience that people don't know what to do with this. I mean, it's information. And what I've noticed over the last 2 decades, plus it's actually been 22 years, is that people have never been trained to sort information, right? They've never been trained to sort out the hype, the fear, and the noise from what's significant. And that's the problem. And one of the reasons I stopped going on TV was because soundbite advising actually is the problem, and I stopped doing it. And so I'm pretty excited about what's coming up to replace the blog. I got one more price chart I'm going to show you, then I'm going to hit the pause button, guys. I saw a tweet by Josh Brown. And Josh Brown is a pretty well-known guy. He's the CEO, maybe the CEO and president, maybe just the president of Ritholtz Wealth Management. And he is a great writer. And their company is very innovative with how they market. But I think they're very conventional in how they manage money. Just my personal opinion. And so Josh Brown brought out this price chart of showing energy divided by technology. And his whole point was, I've seen a couple different of these charts lately, but Josh's was saying that energy divided by technology, and they said, reversion to the mean, meaning there's going to be a point where technology underperforms energy. And I just thought, well, first of all, it doesn't have to revert to the mean, right? There's actually very few things that have to. People are still waiting for the price to earnings ratio to revert to the mean. And I believe they've been waiting about 23 years. I'm not kidding when I say 23 years. July 1997 is when the PE ratio on the US stock market was as high as it was in 1929. And so people just, they aren't trained how to sort out the fear and the hype and the noise from what is actually significant, what actually matters to money. And it looks very likely that this relative performance of energy divided by technology is going to get right back down to its 2000 lows. But that doesn't mean it needs to revert, right? Just because someone can divide something by something else or look at something, because there's just so much data, there's so much information, there's so much noise. Just because someone can do it doesn't mean it's important. And I really want to strive more and more towards training or just really focusing on how do you eliminate the noise and doing it in my weekly commentary and not adding kind of to the noise. So it just reminded me of that when I saw this chart, and how just because something can be measured or looked at doesn't mean it's important. Thanks, guys, for being in my world. I appreciate it. This is RC Peck. And until next time, this is Fearless Wealth. Take care, guys.